Good afternoon, ladies and gentlemen, and welcome to Friday afternoon's presentation, our open discussion forum for power options applied, and radioactive trading. Of course, the big news in the market this week is obvious. Everyone who was trading or not trading is probably aware of what happened yesterday afternoon. We, of course, will address any questions you have regarding that. This presentation, of course, we do not have any planned material to present. The whole point of this presentation is I'm going to sit back. You guys can, ladies and gentlemen, you can ask me any questions you want to about general options trading, tools on power options, radioactive trading principles, or power options applied. But there is no set presentation here other than the first few slides we'll go through just to introduce what we're going to go the processes and procedures for this afternoon. My name is Michael Chupka. I will be your host for this afternoon's presentation. I'm the Director of Education here at Power Options. Power Options, of course, is a patented suite of search and analysis tools designed by self-directed options investors. Ernie Renner created Power Options about 12 years ago. I've had the great pleasure of working with Ernie and Greg Renner for the past 7 years or so. I handle a lot of the coaching sessions and education on the site. I've co-authored 2 books with Ernie, one on naked puts, one on protective option strategies. Power Options, of course, supports over 23 different option strategies. I am versed in all strategies on the site, but there are certain strategies I do not trade in my personal portfolio, such as iron butterflies, naked calls, short straddles, and short strangles. Those particular strategies don't match my personal risk-reward tolerance, so I do not trade them. That's just a little bit of background to me. Now, for the processes and procedures for this afternoon, use the question pod over on the technology that we're using this evening, on the little platform we're using this evening, to pose your questions. Ask as many questions as you want, and depending on the frequency of the questions or how many we receive, we may not have time to answer all of the available questions, but we'll try to get through them as best we can. And as I mentioned a few moments ago, the questions can be about the tools on power options, radioactive trading, power options applied, general option strategy, market discussion, basically what have you. And if there's a question I can't answer, then I'll pass it off to Ernie and Greg, and we'll get back to you when we can with a real good definitive answer. Okay? And some of the just basic ground rules for this afternoon's presentation. Let's just have respect for one another. Be patient again. There may be several questions ahead of yours. Like I said, I'm going to try to get through them all, but we only have slotted an hour time frame here. Again, I want to remind you that this presentation is based on your questions. It's a forum for you to ask questions that maybe you have down on your notes there next to your trading desk, things you've been wondering about. If there's a certain question you have about a tool on power options, for example, or if you just want to discuss the philosophies about radioactive trading, for example, or some of the different strategies, that's what this presentation is geared for. I don't have any set material to present. So what really makes this presentation is the questions that you guys have, and just send them to me whenever you're ready. And of course, feel free to help us help others. If I'm answering a question and you have a personal experience or insights that is a little bit different from my question or something that you've seen in the market, feel free to use the question pod to send me your comments, and I'll share that with the rest of the group as well. Most important, it's been a rough week. It's been a rough past few days. It is Friday. We're heading into the weekend. Let's just relax, have some fun, and try to get some good education out of the material and out of the time that we have today. All right, with that, I'm going to navigate over to the Power Options suite of tools. Again, I'm going to prompt anyone that has any questions to go ahead and start sending them in. I haven't received any questions yet, but just go ahead and use that question pod there. Send me any questions that you have. For those of you that are currently on your 14-day free trial to Power Options, I just want to remind you, of course, that if you subscribe to Power Options before the end of your 14-day free trial, you will receive an additional 14 days for free. So have use of Power Options for 1 full month before you're technically being billed for Power Options. Also, you see here on the main page over on the far right-hand side, there's a link to sign up bonuses. So during your 14-day free trial, if you've recently subscribed, you want to make sure that you click on that, and that will give you some ideas on some of the benefits that you can get there. Okay, the first question came in. It's regarding the radioactive trading principles. Radioactive trading, of course, was developed by Kurt Frankenberg. It's a site that we're partnered with. The radioactive trading methodologies take advantage of using a married put position to enter into limited risk positions but still have an unlimited upside profit potential. And then we take a look at 9 different income methods that you can use off of that to generate income, pay for the at-risk amount, and earn extra income. Now, Larry's been attending some of the free webinars that Kurt hosts every Tuesday and Thursday afternoon. And Larry says that he is interested in radioactive trading, but he's still concerned about down markets. Does radioactive trading have strategies for bear markets? Well, yes, yes, and no. Well, what I mean by that, Larry, is that in just a straight married put strategy, we do offer income methods that can be used in a bear market so that you can lower your break-even point. You still might be able to lower your max risk, though some of the bearish income methods do increase your risk if you adjust the put option and put yourself in a better position going forward. Can I reverse this initial setup that we're looking at here over on the right-hand side? You see the profit and loss chart of the married put. That's our initial setup, a limited risk position with unlimited upside profit potential. Can I use a reverse technique there to mimic the same thing but in a bearish market? And the answer is yes, but it's a little bit more difficult both fundamentally and technically. What I mean by that is a lot of people will assume that, well, if I just want to reverse a married put, I'm naturally just going to go ahead and do a married call. Well, the married call does give you that reverse risk-reward tolerance. Now I have a limited risk on the upside if the stock moves up against me. The married call consists of selling a stock short and then buying a call option. If we're doing it in the radioactive trading methodology, I'd be buying shares of stock. It is Friday. I must apologize for that. I'm going to be shorting shares of stock and buying an in-the-money call option that's several months out in time. The problem with doing this in this fashion, using the married call and then just reversing the income methods, is fundamentally this setup will go against the general concepts of radioactive trading. Radioactive trading is designed as a methodology. Yes, as Larry mentioned, it is for bullish markets essentially. We're looking for bullish positions when we open a radioactive trade. And if I just simply reverse the process here with a married call, when I'm trading radioactively, the goal is to have a limited risk position, and then I'm going to look to make adjustments off of that position that lower my risk over time. If I do a married call position where I short the stock and I buy an in-the-money call option, I'm going to end up I'm going to end up having to pay a fee, usually a monthly fee, because I'm borrowing shares of stock from my broker. So every month that passes by that I'm in the position, I'm actually increasing my risk using a married call position. There are some things that Kurt is looking into. He hasn't been trading it, so he doesn't have a track record on that, Larry, and that is using long puts instead of the married call, so we're not charged that monthly fee and end up increasing our risk on a monthly basis. Now, that poses some other problems. In a married put position, when I'm long stock and I'm long a put, even in an IRA account where I'm restricted, for example, in my retirement accounts, of the 10 different income methods, because I can't do spreads in my retirement accounts, I can only do income method number 1, 2, 3, 4, 6, 7, 9, and 10. I can't do income method number 5 and 8. If I was to follow this in a bearish technique, using that out-of-the-money long put idea, which is sort of synthetic of a married call position, which we might be trading radioactively, the problem there is in my account, I wouldn't be able to do any of the income methods reversed against that long put because I couldn't sell puts against the long put. I couldn't sell credit spreads against the long put, for example. I wouldn't be able to do that. Of course, in that really restricted retirement account, I'm not able to short stock anyway, so I couldn't do the reverse, the standard married call position there. So that's some of the problems that come along with this. About, I want to say 7 or 8 months ago, back in February, or actually, I'm sorry, about 13 to 14 months ago, in February to March of last year, what I actually started playing around with was bearish collar spreads. What I mean by that is a collar is a standard collar is a position where I'm going to buy shares of stock, sell an at or out-of-the-money call option, and at the same time buy a 1 month out, same month out, or same month to expiration, out-of-the-money put option. Now, if I just go into the standard search for the collar spreads, what we'll see here is a variety of positions. I think I still have these standards, my standard collar search up. Yes, I do. So just for example, on Best Buy here, with a stock trading at 41, I might sell the June 42 strike call for 237, and at the same time buy the June 39 put for 202. This would give me a potential return if I'm assigned if the stock moves above the short call strike price of 3.2%, but I'm only risking 4.1%. This is what we call a standard collar. The profit and loss chart, let's just link to that very quickly, is going to look similar to a bull call debit spread or a bull put credit spread. We have a maximum risk, or I'm sorry, maximum gain capped at the top and a maximum loss down at the bottom. The difference with the collar approach as opposed to a bull call debit spread is that the maximum risk is capped to single-digit percentages of my investment in the stock because I've purchased that put option. Yes, I have to pay more money because I'm buying stock. I have a higher net debit, around $4,000. If I do the bull put credit spread or the bull call debit spread with a similar risk-reward profile, my at-risk amount monetarily might be around the same, but the percentage of what I'm investing in the debit or what I have at risk in the put credit spread might be as high as 30, 40, or 50% because it's a leveraged position. I might be looking to make 15%, but I'm risking about 40 or 50%. Really, when we're looking at a debit spread, if I paid a debit, my maximum risk is 100%, which would roughly be around the same monetary value. I just wanted to bring this up real quick because one of the things I started to do in the last bearish market is in these collar trades, what I started to do is instead of doing a reverse collar where I shorted stock, sold an at or out of the money 1 month out put option, and then bought an at or out of the money call option in a restricted account, what I look to do is the what I have here called the reverse long collar same month. So this takes the standard collar but reverses it, so I'm still long stock. But what I'm going to do is I'm going to buy shares of stock and sell an at or out of the money call option, but at the same time I'm going to buy an in the money put option. So my total here in this position, it's let's do the Whole Foods, the WFMI position here. If I bought shares of stock at 36.68, sold the May 38 call for $1.47, and then bought an in the money June, these should be the same months. Why isn't that doing that? Okay, I apologize. Let's do this. I want to go to the new core position where they are the same month to expiration. Okay, so let's take a look at this new core position I just highlighted. This is a reverse, what we call a reverse collar. It's not a short collar, but we're reversing the concept because we're buying stock, selling an at or out of the money call, and buying a deep in the money put. Now, in this case, my total, I'm actually paying a debit of $3.10 here because I'm going to collect $2 for the short call and pay $5.10 for the long put. But my total break even is $47. Now, that's okay because I've got a 49 strike put option. And what that looks like is we do have a percent if unchanged of 2.1%. The stock stays below the short call strike price, but our maximum loss on the position is about 4.2%. That's a 2-to-1 risk-reward ratio. But what this looks like when we take a look at the profit and loss chart, even though we're long stock, because we're buying a deeper in-the-money put option and selling an at or out-of-the-money call, we've now reversed our profit and loss chart. So if the stock drops as I'm expecting, or it stays the same or moves down in price, below that short call strike price, I'll make the 2.1%, and the most I'm risking if the stock goes the wrong direction and moves up would be 4.2%. It's sort of a bearish standard collar. Now, I don't suggest doing this unless you're a more advanced trader, and you look at this profit and loss chart and you say, oh, it's the same thing as a bear call credit spread. And I would take a look at that as well. Before doing a reverse collar, I would compare this to a bear call credit spread based on what you can trade in your account, and that would give you some ideas on what you might be able to trade, what best matches your personal risk-reward tolerance. So I've taken the long way to answer your question, Larry, in discussion of what I've heard Kurt say before about why you don't want to, if you are going to do it in a bearish market, why you don't want to just reverse it and do the married call, why you'd want to do potentially an out-of-the-money, far-term long put instead of a married call position. Another concept would be maybe looking at these reverse collar positions where you're still only risking 4.5%, maybe 5% of your total investment. It does seem backwards because you're a long stock, but you're betting on a bearish trend. You're looking to make maybe 2, 2.5%, 3% if the stock stays below the short call, but you're only risking about 4% if the stock moves up in price. And then you could compare that, of course, to the parity trade of using a bear call credit spread. But as we saw yesterday, anyone who was in a credit spread yesterday with a stop limit order, or I should say a bullish credit spread, or was in an iron condor, you kind of know exactly what can happen with contingent orders on on a severe market correction error, whatever we want to refer to it as we saw yesterday, because those contingent orders get triggered, and then in just an instant the market was back up. You didn't really have a chance to effectively manage it, and that can happen. One other thing, Larry, that I know that many radioactive traders have done in the past when they thought that the market was going down is they'll still do the married put positions, but they'll look to apply the married put, the radioactive trading techniques, and all the 10 income methods on inverse ETFs, short ETFs or ultra-short ETFs that will actually be moving up in price as the market crashes. That being said, there's an easy way that you can identify those. Let's just try to do that. We'll go into the married put tab as we normally would. We'll access the search tool where we pull up the default radioactive search criteria for the married put positions. And for those of you who have been to a free webinar before or have purchased the blueprint, you know that Kurt prefers to look at a universe of options in the IBD 100 and canceling list. But knowing that I could create RPMs, radioactive profit machines, married put positions, on inverse ETFs, for example, what I can do is just change this list here, and instead of looking at the IBD 100 and canceling list, I'll go ahead and look at the inverse ETF list, the counter market, and let's see if we have any results here. Okay. Now here we have the ProShares Short S&P 500 ETF, the SH. This sort of mirrors the SPY. So you see here we could buy shares of stock at 51.91, or shares of the ETF right now at 51.91. We have a couple of different strike prices here, risks of about 7%, 7.2%. If we looked at the November 58, the November 60, for example, the November 24. And of course this would look like a standard married put, but remember it's on an inverse ETF. So if the market's dropping, this inverse ETF is going to increase in price. So this is just another way, using that inverse ETFs, where you can approach a bearish market radioactively. Now, Kurt and Ernie and Greg are currently in discussion regarding some ideas and some concepts of what we're going to present as possible techniques for the bearish strategy. I will say this, Larry, and for everyone else who's online, of course, too. One thing that Ernie is kind of concerned about with people trying to approach this using the married call technique in a bearish market, or using that out-of-the-money long put instead of the married call, is that even though we are in bearish times, and even though we know that the market, when it drops, tends to drop faster than the market goes up, historically, the stock market is up, of course, you know, about 80% of the time, 70 to 80% of the time. When you're doing a bearish technique, even a protected bearish technique, a lot of your success is going to depend on timing, because the market drops fast, and when it drops, it's going to drop fast. But your adjustments are going to have to be more timely than they would have to be on a married put position when the stock is just moving up gradually. Okay, so I just wanted to address that there. And of course, Larry, if you have any questions about this specifically, or about some of the tools I just went through, or my philosophies on that, send me an email at any time, you know, or just give me a call. You send an email to support@powerop.com, or just give us a call at the toll-free number, and I'll be more than happy to go over the tools with you a little bit more and go through some of that discussion with you as well. No problem. All right, I'll wait for, just want to prompt everyone else, you know, if you have those questions, go ahead and send them in. We just handled Larry's question. I'm looking for some more questions to come in, so if you have anything, go ahead and send them our way. I'm going to pull up an option chain real quick. I wanted to point out something that was an interesting occurrence this morning. I've seen it before. A customer had called, and he was actually in a put position, a put option on Walmart. He was in a married put position, but it was a shorter term position. He had the 55 strike put option open. This morning when he called, the stock, Walmart, was actually down at about $49 per share. And what he was concerned about is he was looking at the position, and his stock was down, I think, about, I think the average price, or his monetary value that he was down on the stock was $2,000, but his put option was also showing him that he was down about $80, which doesn't make any sense. If my stock's down $2,000, I think he had 400 or 500, I think it was 500 or 600 shares, 500 or 600 shares, excuse me, 5 or 6 contracts. Well, if the stock's down, $2,000 in value, the put should have increased to counter some of that. Well, what he was seeing was a very interesting phenomenon that happens sometimes in the morning. Can also happen sometimes if you have options that are further out in time. Now, let me just transfer over to the 5-strike put chain, and I'm going to look for an example of this further down the line. Let me see here. That's not good enough. That's not good enough. I'm looking for something specific. I will find it. Maybe I won't. It was also very high volatility this morning, so that sort of helped out a little bit. Let's see. Now, these prices had enough activity, so they weren't there. Not a good example. Okay. Well, what had happened this morning when he was looking at his brokerage account, and even when he was looking at power options, when the stock was down, the stock had opened at about $49.50, $49.80 per share. He was holding the 55 put. Let me get the pen here. So his intrinsic value should have been about $5. Let me clear that up. Hold on one second here. Should have been about $5 and about 30 cents. That should have been his intrinsic value for this option this morning. However, because there was no option volume yet, the option volume hadn't traded, and of course yesterday, the end of activity, there was a lot of activity going up and down. What he noticed, because there was no current option volume, no one had traded this option, the bid price for his 55 put, when he had called me up, which was about $5.30 in the money, the listed bid price was $3.50, and the ask price was about $5.80. So there was this wide gap in the bid-ask spread for this option this morning, about 10-15 minutes after the market had opened, because there was no volume. Now, he had some other questions, and we went through the other questions. When he first asked this question, how could my put be down this much, or how could my put be down at all if my stock's down about $2,000? It was down about 4 points from where he bought it. And what I explained to him is that the put really hasn't lost money. He had paid about $3.70 for it, and with the natural bid price at $3.50, the most likely price he'd get if he put in a market order to close the position, that was showing a loss from his original price at $3.70. However, it's an unreliable price. It was well below intrinsic value. Because there had been no volume, the listed prices that were showing in the exchange were what the market maker had for a natural bid. Someone had put in an exchange order to probably buy to open this position at about $3.50, and someone else was trying to sell to close it at $5.80. So the market maker had reversed that. So your ask price was listed at $5.80, and the bid price was listed at $3.50. I, of course, told the customer, what you have to do is just wait for a little bit. Eventually, an order is going to get triggered. Someone's trying to put in different bids and asks here, and the market maker will even adjust it. I myself have been looking at an option chain when I'm, let's say, trading a covered call or a collar spread on a low-price stock that doesn't have a lot of volume. And I've come to the power options chain and seen no volume, and let's say the option has a bid price here of $3.05, or let's say $3.50 and an ask of $5.80. I put in a limit order to sell to close my put, or to sell to open a call option halfway between at about $4.70. As soon as I refresh the option chain, the new listed bid price is $4.70, and then the ask price is still $5.80. So that's kind of the tricky thing there. But while we were on the phone, after I answered his other questions, we went back to the option chain and took a look at it, and sure enough, 4 contracts have changed. 4 contracts had traded, and now, after that had happened, the natural bid price was listed at about, what was it? Hold on, let me think about the numbers here. Yeah, the natural bid price was listed at $5.30, and the ask price was at $5.80. So it had moved because someone had actually traded the option, and we could get a better value of it, and his position no longer showed a loss on the put. He now had a gain, I think, about $1,600 on the put, and a loss of about $2,000 on the stock, which he should have seen. Okay, Let me just scroll up here. I have some other questions coming in. I just want to address that. All right, looks like Stanley had some problems. I don't know if anyone else has had any problems. Everything seems to be functioning fine. Stanley said his screen had froze. He had to close and rejoin. Does this happen often? I missed quite a bit when I realized my screen should have changed. Well, I apologize for that, Stanley. I have seen in the past, I haven't had a lot of customers have that problem, but I have had the issue, let me put it that way, where I've locked up while I'm showing one of the screens, and I don't understand why that happens. We've been after and in discussion with the GoToWebinar support staff there to try to identify why that happens. You did have audio the whole time. That's good. Now, Stanley, I just want to remind you, hopefully we don't have a screen lockup today on my side. I am recording this presentation. I know I haven't gone very in-depth into a lot of the different aspects of power options. We've only focused on a few questions here. But I am archiving this, and I hope to have it up maybe early Monday or late Monday afternoon. And I'll send you an email when that's archived so you can go through any of the material that you missed at the beginning. Okay. So with this wrap up here, or not wrap up, but just here I just wanted to remind everyone, if you see something in your portfolio that looks a little strange, where you think, okay, my stock has dropped, my put should have increased, or something on a covered call position looks too good to be true, your stock went up but your option premium didn't move, and it looks like you have a very significant gain because you don't have to, the ask price of the call option that you're short isn't that high. Check the option chain and check the volume. If you see no volume today, then you probably have a wide bid-ask spread just because no one has made a trade yet and the market maker is taking the bid and the ask prices that he can see electronically and trying to force people in at those positions. But as soon as you see one or two contracts trade on that stock or that option, you'll see a better pricing. That bid-ask spread will reduce a little bit more, and you'll probably be where you expect to be. So if I see a gain of 4 points in the stock, if I'm in a covered call and my stock this morning has gained 4 points, but it doesn't look like my call price has changed at all from where I originally sold it, I know that's probably not possible. If I'm in a married put position, my stock has dropped 4 points and my put hasn't changed in price from when I purchased it, I know something's wrong there. There's not a lot of activity. I'm not getting a lot. There's probably a wide bid-ask spread. But once I see some activity there in the option volume, for the current option volume, mind you, then I'll get to see a good spread. You will also tend to see wide bid-ask spreads in more volatile instances. For example, let me just pull up FAZ. This is one of those ultra-short, this is actually a 3 times financial bear. And if we go a little bit further out in time, oh, of course, today's the day where there's so much activity that I can't prove my point. How about that? The other day when I was looking at this, there were wide bid-ask spreads, but it doesn't look like they're that big right now. Maybe they're wider in the calls. Let's just check the 5 straight call chain. No, they're about the same there. Okay, let me think. Let's go to an old favorite, ladies and gentlemen. I know a couple people, a couple customers of mine have made a lot of money on this position recently, on Dendrion. I know a lot of customers that have lost money on this. Usually when you see a more volatile position, you see the implied volatilities of these options here on Dendrion. They're not extremely high. They're up near 0.8, 0.9, for example. But a lot of times that's where you see the wide bid-ask spreads. But these are not as wide as I'm looking for. Let me go down. Let's take a look at some of the deep out-of-the-money, far out in time out-of-the-money calls and puts. Still not as wide as I've seen in the past. Well, there's one, but it's kind of a ridiculous position. See the January 2011's, the decent bid-ask spread here, far out in time. Let's see here. We have about 60 cents, 75 cents here on the at-the-money January 40, about $1 bid-ask spread, but there's still tons of volume here, so that helps limit it down there. Okay, let's see here. All right, let me just go back to that. I just want to take a look at FAZ again. Stanley just wrote in and says he looks like he bought to open FAZ at 14.21. Okay, so you have a small gain here. Market was a little bit less volatile today than it was yesterday, but I'm sure we all are, depending on what kind of strategies we're in, we're not seeing what we'd like to see right now. But that's good, though. And Stanley, I assume that you're sort of an experienced trader, an experienced investor. I myself, as I mentioned earlier on, I've been trading options for 7 years, been working with power options for 7 years, been trading options for 7 years. I tend to avoid the 3 times bull and bears. It's just, you'd think that I have a you'd think that I have an advantage because I'm here all day long, and this is what I do. I teach strategies. I have power options open. But I've actually found, because I'm on the phone so much or working on articles or working on new books or educational materials, I find that I tend not to be able to watch the market as much as I would want to. And a couple of times I've tried to trade those 3 times bulls and those 3 times bears. It wasn't a volatile market, but I found myself essentially over trading and making adjustments more than I wanted to. So I've actually stepped away from the ultra shorts and the 3 times bear and the 3 times bull ETFs for now. But I know they can be very lucrative positions, and you just got to be careful. You might want to consider adding some protection to FAZ as time goes on. If the market starts to change or it starts to settle down a little bit, you just might want to watch that, Stanley. Those things, I'll be honest with you, they make me nervous. I probably don't understand them as well as I should, but the couple times I've tried to trade the ultra shorts and the 3 times bull and bears, I made money, but I should have made a lot more. I ended up just over trading, over panicking, not paying attention to when an alert was triggered, then having to go back and wait for it to trigger again before making an adjustment. It wasn't what I want to spend my time doing, so I actually stay out of those for now. Okay. All right. So yeah, okay. Stanley's using this as a defensive position, and that's good. What I did, my first experience with the ultra short ETF, Stanley, I think it was on, I think it was SDS. I did. Let me think there. What I did is before the crash of 2008, I didn't want to spend time buying puts on all of the stock positions I have because I thought that would be too expensive. So what I did is I broke down my current portfolio, what I was holding, and I noticed I had X percentage or this amount of monetary value tied in S&P 500 stocks and this amount of monetary value or this percentage of my portfolio in NASDAQ stocks, for example. And rather than just buying straight puts against those positions, what I tried to do is take that percentage and apply it to a number of shares of the ultra short, or 50% of the number of shares of the S&P 500 or SPY, and converted that into this ultra short SDS. Thought process being, of course, if the SPY or the S&P 500 or the stocks in general just started to fall, then my SDS would counter that. And I'm not sure about the 3 times because I haven't looked at them that intensely, but what I really had a problem with using the ultra short S&P 500 and the QID, which is the ultra short for the NASDAQ, is that when the SPY dropped, I saw a gain on SDS of about 1.4 to 1, not 2 to 1. However, when the SPY started to move back up on a daily basis or on average over the week, I saw a loss of 1.8% on SDS. So that didn't seem very fair to me, that every time SDY dropped, I was gaining a 1.4 to 1 ratio, and every time SPY went up, I was losing 1.8 to 1. So it didn't seem to work out for me, and I went back and I did some revisions, and I looked up some articles, and I found out that yes, the SPY or the SDS here, these are these ultra shorts and the shorts are essentially derivative based on about 80% of the actual ETF that it's monitoring. So that explained the discrepancy of why I wasn't seeing the 2 to 1 movement that I expected to see. So it didn't work for me as a direct protection. I had to make some other adjustments and use different ratios, and then I just decided I'd be better off just using straight puts on those positions, or just straight puts on the SPY, for example, or the cubes, to help counter or ensure my whole portfolio. And now, of course, as many of you know, most of my core positions in my portfolio are standard married put positions, RPMs, following Kurt's radioactive trading principles, but I do have my own method of stock selection, and of course the standard collar spreads that I started discussing earlier. One of the things I wanted to mention is that for the various strategies, when Larry asked his question about looking at bearish approaches to radioactive trading, I sort of blew through a lot of things that some of the new people that are joining us today might not have been familiar with when I started talking about bearish collars and how they have a relationship to bear call credit spreads, or if I'm looking to do a standard collar itself, I'm going to look at the parity trade to the bull call debit or the bull put credit. If that was a little bit too much information for you at one time, what I'm going to suggest you do is go into the Learning Center. From the main Home tab here on your Power Options account, go into Learning Center, and go to Webinars from the Learning Center menu. I also want to focus on the URL at the top here, www.powerup.com/webinars.asp. The reason I want to highlight the URL here is because this is a free page. If you type this page into your URL, if you don't currently have a Power Options trial or you're not a Power Options subscriber, you can still navigate to this page. And I bring that up because anyone who goes to Radioactive Trading, Power Options Applied, or PowerUp.com, you can sign up for one of these free webinars even if you don't have a trial or a subscription account. If you type this into your URL, you will go to this page. It is a public page. Okay. And what I'm over here to the right are some of our previously recorded webinar archives. And if I click on the Option Strategies archive, you'll see here that there is a parity trade discussion which talks about covered calls versus naked puts. There's two-part series on the vertical spreads, part 1 and part 2. That's discussing the bear call credits, bull put credits, bull call debits, bear put debits. And I believe in part 2 I go through more of the parity discussion of why is a bull put credit spread a parity trade to a bull call debit? Why should you analyze both before entering one or the other? But these two down here, the Protective Option Strategies Part 1 and Protective Option Strategies Part 2, I believe in Protective Option Strategies Part 2 I get into the more advanced discussion. This is mainly focusing on collar spreads. And in Part 2 here of this archive, I go into a deeper discussion on sort of using that bearish collar approach, some of the pros and cons of using it, why you'd want to compare it to a bear call credit spread before actually entering the trade. So you can access these archives at any time to get a little bit more strategy information. And of course, in most of the presentations when we're discussing a strategy, we're also showcasing using the Power Options tools to implement that strategy as well. There's also some other discussions on the general tools on Power Options. You have some archive there for the Power Options tools. The other open discussions, as I mentioned to Stanley, I'm recording this one, so we should have that available hopefully sometime Monday, maybe Monday afternoon. And also archives for Radioactive Trading and Power Options Applied. And of course on this page as well you can sign up for any of the upcoming webinars that we have. As I mentioned earlier, Tuesday, May 11th at 12 noon. We'll be having that free webinar with Kurt Frankenberg at Radioactive Trading to discuss his methodology. We usually host those every Tuesday and Thursday at 12 noon Eastern. And I'll have some other presentations next week as well, on just the Power Options tools, maybe a strategy discussion on Thursday as well. So those archives, remember up here at the top, you can just type that into URL, www.powerup.com/webinars.asp. Okay, and that'll take you right to this public page here where you can look at the archives of those different materials. If you had questions about that little bearish collar I was talking about, you could go to the Strategies archive and Protective Option Strategies Part 2 to get some more information about that. Of course, I also discussed the bearish collar in the Protective Option Strategies book, which focuses on married puts and collars and the different combinations of those strategies you can use in different markets. Okay. All right. I don't have any other questions coming in right now, so I'm going to focus on two things that might be relatively pertinent. Of course, in this market and what we saw yesterday, if you're trading a covered call with a stop loss on Thursday, if you're trading a credit spread bull put or a bull call debit spread, for example, with a contingent order or a stop loss yesterday, I hate to say it, I know what happens. You got stopped out and you sort of got salt poured in the wound right after that. The market dropped so quickly, the error, whatever we want to call it, it dropped so quickly, the contingent order snapped. Is almost like having a stock with a stop order overnight that had earnings coming out and it dropped 30% and you thought you were safe with a 5% stop loss on your position. Come to find out that the stop loss doesn't protect you against an overnight drop and you actually got closed out for a 25 or 30% loss first thing in the morning. I know that happened yesterday and it's a terrible thing, and hopefully all the research that's going into this is going to give us a lot of different views and a lot of different hopefully accommodations to what happened. But in that discussion, what I want to bring up, of course, is, the only way to guarantee yourself a limited risk on a position if I'm long stock is to use a married put or a collar. Stop losses don't work. the stop loss gets triggered, you get closed out, and then yesterday you just see the stock go right back up to where it was before the stop was triggered. You still suffer a 10, 15, 20, 30% loss or higher, higher on the leverage spreads, such as the credit spreads, for example. So protecting on a big drop one way or the other, I mean, the married put techniques, the collar techniques are really the only way to protect it. Standard collar, of course, caps your upside, whereas the married put does not. And as Stanley asked earlier, I'm sorry, not Stanley, I apologize, as Larry asked earlier about the bearish approach, using maybe those married calls, which I'm not going to suggest, or those out-of-the-money long puts, which Kurt talks about from time to time, you've got a limited risk on the upside on a bearish position, but still a very high potential downside profit because the stock can drop to zero and you'll reach the maximum potential profit there. But that being said, we've been down recently, and if you have a stock that's dropped in price, we do have a tool that you can use to help you get back to break even. For example, let me take Kraft. I take Kraft because Kraft is a position I'm in right now. I'm in it as a married put. I actually have it bulletproof right now, and the earnings just came out yesterday. So what I'll do is if I want to access this repair tool, I'll type in my stock symbol here, and I'll just click on Stock Repair. Now this will take me to a field where it wants me to put in my cost per share and my number of shares. What the repair strategy attempts to do is to build ratio credit and debit spreads to help you get back to break even faster. For example, I know that Kraft closed today at around $29.80, $29. It was a little bit over $30 per share. But let's say I had actually purchased 200 shares of Kraft. I'm sorry, let's make it simple. Let's just say I bought 100 shares of Kraft a month or 2 months ago, and I actually bought it, let's say it was trading at around $32 per share. $32.50. Okay? I'm going to ask the system, can you find me a repair because I bought stock at $32.50. Kraft right now is trading at $30.07. And so what the tool tried to do for me is it's trying to build a repair, making use of it started off trying to build a credit repair using the June 30 strike and the June 31 strike. And this will give me a very limited net credit. But you notice here how I don't have any trade details. And what the system tried to do is build the standard ratio spread it was looking for with those two strikes, but it couldn't make it a profitable position based on where the stock has dropped. Okay? But if I look at the next one, I've got a September series here where, again, it tried to build a repair using long September 30 strikes and short September 31 strikes. I could generate a net credit right now of 76 cents. And now this is interesting. I have stock at $32.50 that's currently trading at $30.07. If I perform this repair, which is all the way out to September, however, if I perform this repair, I have a break even now of $30.87. Well, how does that work? Well, if I wanted to see the information, I'll just click on the repair details. Okay? And what this shows me is the breakdown of my position. Remember, we had 100 shares of Kraft at about $32.50. So this breaks down that I could buy one September 30 call for $1.82, and at the same time I could sell two September 31 calls, which would give me a total premium of $1.29. The 31 calls are probably priced, I guess that's at about 65 or 64 cents per share, or per contract, excuse me. So I could sell two and collect $1.29. I could buy one for $1.28. And this will give me a total net credit of 76 cents. Now, as I scroll down a little bit further, what would happen if the stock was trading at $30.87 per share? Well, remember our cost was $32.50, so we'd have a total loss on the position of $1.63. With the price of $1.63, I'm sorry, we have a loss on the position of $1.63. My long call value at September expiration, if the stock's trading at $30.87, would be 87 cents. Remember, we keep the net credit of 76 cents that we received. So, with a stock at $30.87, we have a loss on our total position of $1.63, but we have a long call value worth 87 cents, and a total net credit we received of 76 cents, so that puts us right at break even. This profit here counters our loss in the position. So now instead of needing the stock to move back up to $32.50, we could potentially get back to break even with the stock just staying at 30.87, or just moving up to 30.87, only 80 cents now. Now there is a small probability of that happening. Kraft moves a little bit slower, but that's what the repair strategy can help you identify. Now one of the downfalls of the stock repair strategy is that, yes, it will help me get back to break even faster if the stock moves up. I'm expecting, now that my stock has dropped, I'm still expecting that it's going to move up in price. And here, I'd expect that the stock would still be trading at around $31 or $30.85 at or on September expiration. It does not do that much to cover my downside. Let's take a look. Okay, so if I click on Analyze Trade here from that position, this will take us to the profit and loss chart. Here's our stock position on Kraft. Here's our long call and our short call combination. And we see here that we can help ourselves, instead of needing the stock to go back up to 32.50 to get to break even, we hit the break even at 30.87. Okay, so we just need a smaller move now to get back to break even. But what haven't we done? We haven't addressed anything on the downside. We still have essentially 100% of our $3,174 invested at risk. If the stock continues to fall, we've only give ourselves a downside protection of 76 cents. So if you have a stock that's dropped a little bit in price over the last 7 days, last 5 days, and you think it's going to come back up in price, you can use the stock repair strategy to help you get some ideas on positions that might help you get back to break even faster. However, remember, keep in mind, this does not address the downside. If the stock continues to fall, you haven't really lowered your cost basis that much. You're still on the hook for a large amount of invested capital. Again, the only way to protect against that is at the same time you do one of these stock repairs, you might want to go ahead and look at adding a put option to that as well, buying maybe an at, or you typically, in this case, I'd maybe look at buying an out-of-the-money put option that has the same expiration date of the repair strategy. So I'd look at maybe a September, with Kraft at 30.07, I may look at a September 28 or maybe a September 26 strike put option. Hey, let's do that real quick. Let's see what that would look like. All right, so what I'm going to do is I'm in the profit and loss chart now, and we can use up to 4 legs here. We have our stock position. Here's our stock repair tool, and stock repair spread, and we just saw the position, the profit and loss for that position down below. Now, if I want to consider adding, with a stock at $30 per share, let's say I want to consider adding a September maybe 27 or maybe a September 28 strike put. Let's see what's available there. I'll click on View Options at the top here. This will pull up the various months. I'm going to click the arrows over here for the collapsible chain in September. Here are the 2 calls that I've added, that 30 strike call and the 31 strike call. And oof, I was going to collect 76 cents of premium. So let's go ahead and add the 26 put for about 76 cents here. We're going to buy that. We're going to cancel out the credit, but let's see what this does to our position. Okay, and we're only going to do 1. We only have to do 1 put because we have 100 shares of stock, okay? So we're going to buy 1 September 26 put. Remember, this is what our profit and loss chart looked like before. This isn't going to be a pretty position, by the way. I can already tell. And we're essentially going to have no profit on the upside. Let's go ahead and hit submit. Yeah, not a good position. Now, still risk is way too high, 20%. We've canceled all our gain if the stock moves back up to 30.87, so this wouldn't be a good idea on this particular position to use because the put option that we looked at has a higher ask price than the net credit we would have received. But you could run some scenarios on this after you link to Analyze Trade and look at that original profit and loss chart for the repair, and then play around with that View Options link to see if there's any put options that might work with the position there to help you limit the loss instead of still having a 100% amount at risk. Okay? All right. Well, this is, I don't like to be cliche, but this is sort of the last call for questions. It's about 20 after 5. We still got about 10 minutes left in the presentation, but I haven't had any questions come in for a while. I'm just trying to review some information that I discussed with other customers today during different coaching sessions and, of course, during just general phone calls, so I hope that was educational for some of you. But if you have any other questions that you wanted to ask, questions about a methodology, questions about an option strategy, question about one of the tools and power options, go ahead and send those in. Otherwise, we're going to wrap things up for the day and kind of try to put out of our memory what happened this week, what happened on Thursday there. Have a good weekend and then move forward and start again next week as we always do. So if you have any questions, just prompt them. Just go ahead and send them to me. Have a few minutes left here. I'll be more than happy to answer any last-minute questions that you might have about radioactive trading, the tools and power options, for example, power options applied, anything you have, anything you can think of, even general market questions. Go ahead and feel free to ask. While I'm thinking of that, I'm sorry, I just was looking to see if anyone had any questions. One thing I'm going to go into very quickly and just show some examples. In addition to the search tool, we looked at the search tool very briefly for the collar spreads, for the married put positions. We saw some examples there. In addition to the features and the flexibility that the Power Options patented search tool offers in 23 different strategies, plus some of the research tools we just looked at to analyze your what-if scenarios using the profit and loss chart and the other detailed research and information you have on the website, is very important. I'm going to recommend to everyone, even if you're not using it yet, to make sure that you're tracking your positions using the Power Options portfolio tools. If we go into the portfolio, we go into the profit and loss portfolios. I'm just going to link over to Kurt's virtual trading account, the plain vanilla portfolio. Look at some of the positions. Let's see, we still have Herbalife, which has moved up about 6% from the original purchase price, and Starbucks, which is up 7.1% from the initial purchase price. Well, whether I'm tracking married puts, covered calls, collars, even if I'm tracking a long stock, if you have a position in the portfolio that has moved up or down in price, what is the next step you want to do? Well, naturally, you're going to want to manage the position. It takes a lot to do all that math. What happens if I buy back this, roll this, for example? I'm going to buy to close my short call, sell to open a new call, but it's at a higher strike. How do I factor that in? If I'm rolling the put option here for Herbalife, if I sell to close the put and then buy to open a new put, what is my total risk? Well, in all these strategies, we try to take care of that for you. So from the main portfolio tool, what I can do is go to position actions and then position analysis. This will give you a breakdown of where your position stands right now from your original purchase prices. So you'll be able to see the current at-risk amount, for example, the current profit and loss charts. And if you scroll further down, you see we have a liquidation of 2.6%. After 52 days. We could make a profit of 2.6% if we close this position right now. If we hold it all the way to the put expiration date and make no adjustments, we're going to risk about 5.2% if the stock stays at the same price it is right now. But down below you have these potential rollout opportunities. Now, because this is a married put position, I have a variety of different positions. This based on the income methods discussed in the blueprint in Kurt Frankenberg's work. And one of the things I see here that I might look for example, now that my position has moved up about 5%, I see there's an income method number 4 opportunity here with a negative at-risk amount. That means I could bulletproof the position. I could sell to close my 45 put for 380 and buy to open the August 60 put, which would bulletproof my position. I'm going to have to pay a debit to get into this income method, but because I'm rolling up to the 60 strike put, I'll be bulletproof. And you can simulate what that would look like graphically. Just click on the More Information button for the rollout opportunity, select Simulate Trade, and here's we see our position. We took our initial at-risk amount that we had on Herbalife here of 7%. Because we rolled the put option, we now have a bulletproof position. So now in between August expiration, we can't lose any value, but here's the trick. You want to, based on what Kurt calls the SIGA model, when you're reading through the blueprint, if you purchase the blueprint, you're reading through it. If I expect just the stock in the next couple of months to be trading around $50, $55 per share, I might not want to make this adjustment right now. But if I expect over the long term that the stock might move up higher, or if I'm concerned that the stock might drop here and I'm going to look for different income methods, I might want to perform this and bulletproof the position now, so I'm not risking taking this 2.6% gain, and if Herbalife quickly drops, now I'm down to a 2.4, 2.5% loss when I could have bulletproofed it if I'm concerned about the market decline over the next month or the next 2 months. But that's why it's very important to use the portfolio. This is just one example, but if you're looking at just long stock positions that you're tracking in your portfolio, if you're looking at covered calls, credit spreads, you'll be able to link to that position analysis page and look at potential rollout opportunities for your particular positions. All the math is done for you, what your new possible percentage return would be, what your new at-risk amount would be, what your probability would be of earning that return, for example. All that math is done for you, so you don't have to do it by hand. So in addition to the patented research and analysis tools, that patented search tool there and the 23 different strategies, the portfolio tool in itself is a very powerful tool to help you track, manage, and analyze your positions. All right. Well, I'm going to navigate back over to our slideshow here, and we're just going to wrap things up. If you have any last-minute questions, please feel free to send them in. I'll try to address them. Just briefly talk about the subscription services for Power Options. Our 20-minute delayed service, it gives you access to all the tools that we looked at today, plus other ones we didn't get to in all 23 different strategies. It's $59.95 per month, or $600 for the annual subscription. Essentially, you're paying for 10 months but receiving 12 months of service. The real-time is $79.90 per month, or $800 annual subscription. Of course, that gives you access to all the tools and all 23 different strategies with the real-time quotes instead of 20-minute delayed. Now, our historical backtesting features are not included on the 20-minute delayed or the real-time. You can purchase a 3-month access to our historical suite of tools for $99.95, what roughly works out to be about $33 per month. And we also offer a professional level of service. So if you're already on the real-time but you want to get the historical suite of tools, you probably just want to upgrade to the professional level of service. It's only $20 a month more. You get access to everything you had on the real-time plus the historical tools. And, of course, there's also a discounted rate of $1,000 per year. And now, of course, upcoming free webinars, as I mentioned, every Tuesday and Thursday at 12 noon Eastern Time. Kurt Frankenberg hosts the Introduction to Radioactive Trading presentations. Usually every Tuesday at around 9 p.m. Eastern, I host an hour-long presentation on using the Power Options tools for radioactive trading. Wednesday at 12 noon Eastern Time, typically host an Introduction to Power Options presentation. And then, of course, every Friday at 4:30 p.m. Eastern Time is our open discussions as well. All right. Now, if you have other questions, if you didn't get to send in your questions today, please feel free to contact us at any time. You can send an email to support@powerop.com, or you can call me toll-free during market hours at 877-992-7971 if you live inside the continental U.S., or you can reach me if you live outside the continental U.S. at 302-992-7971. Of course, there's also contact links on every page. Well, I don't have any other questions, ladies and gentlemen. Thank you very much for joining me this afternoon. I hope you all everyone, ladies and gentlemen, has a great weekend, and that all of us here didn't get too burned with what happened on Thursday. And again, feel free next week, give me a call, send me an email during market hours. I'll be more than happy to answer any of your questions or go through a discussion with you on how the tools and Power Options can help you. Take care, everyone. Have a great weekend. Good night.